Carrie is the co-founder and CEO of Avant, and she has built $100 million value real estate project before starting her own venture. She also has strong expertise in business management, strategy, and implementation. Now, if you love to have more business insights and listening out to business individuals like Carrie and others, please feel free to sign up for a free membership through our web app. And as a member, you have access to exclusive offers. You have exclusive offers, collaboration opportunities, and complimentary business advice. So, Carrie, welcome back again. Now, I'm so interested and so intrigued by your whole journey to look at veganism and to provide alternative protein in the space of seafood for the seafood industry. So coming back, maybe let's start off with the starting point where you decided to start on this journey. So what sparked your interest and what made you take the plunge and embark on something so different?
Thank you so much, Megan, and thank you for the question. Yeah, it's that I have been vegan for about 5 years, and for the reason of I realized that it is not very sustainable in a way that the way that we supply our meat product. And I actually used to love seafood a lot, and so having been vegan, I understand that there are certain give and take, and I happily removed that from my plate. And I've also done quite a bit of other, activism even to promote this plant-based diet. And I realized that it is not that easy to really change our cultural preferences. We have a lot of dishes with meat in there, and a lot of, the culture and our social life are all surrounding food and other stuff. So I realized it's not very easy to change people's behavior and then their relationship with meat in a short period of time. And then on the other hand, I mean, the consumption is increasing, population and also expanding power in this part of the world, Asia, is increasing. The meat consumption is actually going up. So without the plant-based fast enough to catch up or counteract the action on the environmental impact, and then I stumbled across this idea, we can actually make meat without the animal. That means that we can skip all the environmental problems, as well as potentially even more traceable, more safe, and potentially more nutritional, benefiting for us as a solution. So I was so excited to start this journey more than 2 years ago.
Wow, okay, so it has been 2 years since you have been trying out this alternative cell-based seafood industry. I'm just curious, when you first started out, of course, there are many challenges you face as a business owner. If you could highlight, what are some of the early stage problem statement that has been really tough for you, and maybe, of course, share with the audience here. Many of us here are business owners today, dialing in to listen to you. How have you overcome those challenges?
Right. I think the first of all is the co-founding team. I have some startup exploration kind of things with my MBA classmate here and there. And finding the right partner is not that easy. Finding the right co-founder is not easy. I actually have thought about going on, on solo on some of these business idea. But in this particular area, it involved biotech, and I'm not a scientist. So I practically cannot start it on my own. So I think the biggest challenge is really find the right co-founder who has the complementary skill set and background qualification to you that will be important for the team and the company to get started. And on top of that is how you can work with that person together. So with a bit of twist and turn, I am very grateful, actually very fortunate to find our co-founder and CSO now, Dr. Mauro Chin, through a little bit kind of not very conventional way of finding co-founders. We usually would look out for our friends or classmates, long-term colleague, or even going to certain platform to look for co-founders. I realized that finding scientists is not that easy. So I actually take a little bit kind of different route to identify the right person with the help of advisor, with the help of other network. So I would not do, that's actually a little bit long story. I will not go into that, but happy to talk about that at some point if think that is useful at the end of chat today.
Sure. So you mentioned about finding the co-founding team, and because you started on this 2 years ago, right? I think at that point, the alternative protein market is not so as popular or gaining as much traction as today. So I'm just curious, was fundraising a issue for you to find the initial pot of money?
Yeah, so that's the question for today, right? Regarding
Right.
fundraising, we are not too bad in that position compared to some other companies in this world. So for information, now there are about 50 to 60 companies in the world working on cultivated meat technology, or the enabling technology related to that. And then we're basically around 3 generations. The first generation are those started even about like 3-4 years before us. So they already existing for 5, 6, 7 years. And then life was even tougher for them. And for us, we are the second generation. The toughest thing for us is that this is some pre-market approval kind of, we need compliance.
Right.
Just like P2P lending or banking and blockchain, that kind of thing. So compliance is actually one hurdle. And when we started, a lot of the question is, okay, if you have the technology, if you have good product idea, how are you going to sell? Because there's no regulation, there's no compliance yet, and you cannot sell without that. So we are not too bad in terms of timeline, because now the first case of cultivated meat approval has already taken place. It's actually happening in Singapore, very close to Hong Kong. And I think we are a little bit already quite lucky in that regard. And then now the third generation will be a bit more competitive in terms of the patent space and how we differentiate. So we are actually sitting in the middle. I think we're not too bad in that regard, but we are actually pretty grateful for that.
Very nice. Just in case, Carrie, I forgot to introduce myself. I'm actually calling you from Singapore.
Okay. So I'm not sure whether we've tried that yet. Maybe you're planning to try that.
Oh, I'm a great fan of this new alternative protein.
Okay.
I've tried the alternative protein for beef.
Right.
So I've not tried one for
Okay,
seafood.
for
I
chicken.
really look forward.
Okay.
But anyway, guys, today we're coming back to fundraising.
Yep.
I'm not talking too much about the other food types out there. So let's come back to fundraising, right? So because you have been running this for 2 years, and do you think there is a right time for a business owner to reach out to an investor, or like you kind of just plan it along the way?
So in our case, I really would like to suggest that if that project or the thing that you have started already having some revenue, of course you really think deep about why you need an investor to begin with. There are multiple reasons. In our case, it's more like financial resources, because biotech research do take quite a bit of capital. So it is almost a little bit kind of automatic at some point, early stage. We do need to go out and look for investor. Although among me and the co-founder, we put in money, but it is not large enough to really support long-term kind of R&D research. I think the other that you would like to think about is that if you have a product, your revenue, you might still want to look for investor one way or the other. Is that because investor, when they have vested interest, they actually will introduce to you a lot of network. It could be distributor, it could be some other network that will be very useful and important for you. Although you could also capture this help by asking them to be your advisor. By becoming advisor, you do give out some equity in some cases, although I know that the advisor do not take equity. But let's say the person really dedicate quite a bit of time to try to promote your business, and there are very standard arrangement that you compensate that person with some equity. It will be actually best to have that person being an investor rather than just an advisor, right? Because that person also put in money, so why not? So that's another reason driving that you look out for investor for both finance, network, and potential partnership. There's strategic investor that could be very helpful as well.
Yeah, that's very good advice. Because it is very important to consider whether a individual, an expert coming in, is taking on equity or not. It is going to reflect the level of commitment that individual is going to dedicate to helping you build up the venture. Now, in the whole spectrum of different kind of investors, right? We have angel investors, we have VCs, we have investing firms, equity firms. First of all, could you briefly explain to us what are the difference among each of these, and for a startup at the beginning stage versus say a startup in a mid stage, is there a preference to which one we should reach out to?
Yeah, so maybe very quickly, can those different potential investor groups.
Right.
So of course, there are angel investor, friends and family. Those who really believe in you, whatever you do, they actually have quite a bit of money that they are willingly support your venture without them, in a state whereby they're really tight on the personal finance. So there are actually some rich, family members and something like that, or angels who have been they are like professional who are maybe already very successful in their career. They have a bit of money to invest in different things like stock market, real estate. They set aside some money to take on some more interesting project and a little bit high risk. So these are the angel category. The other is actually accelerator. So we participated in accelerator program, and some actually would take some equity, not all. Some of them would willingly provide a platform without taking equity. So that's another topic we can talk about. Some accelerator do put in some money in return for some equity and in-kind, meaning that they provide you with working desk or some space or access to mentors and advisors. Those are second category. The third is really the VC. VC is very professional. So these are the people who are professionally engaged by some either family office, high net worth personnel, or other people who would like to invest. They would professionally full-time working on that to look into investing in the latest innovation and business model in different industry, different location like geographical market, and different stage of the company. They will be quite specialized. For example, those invest in AI only in Asia, for a stage between seed stage to Series A. So they have a very clear about their mandate. So their business model, if you would like to understand a bit why they invest, you would like to learn about the motivation and the business model on their end. So VC. So a lot of the company, if you have heard about that, a lot of company would not succeed to the unicorn or making a lot of money at the end. So the percentage is not that high. So what they do, the business model is that they invest in a relatively larger number of companies, and then one of them would become the big winner, like the unicorn. There are some will do pretty well, like being bought out and something like that, and some of them would actually would not succeed and fail. So they balance out the model, and then that's how they invest in high risk kind of companies, startup in a portfolio kind of approach. They would make return based on that. And the person speaking with you, they are generally GPs, so they're entrusted by limited partners who are actually the person putting up the money. They do all the deal screening. They look at different opportunity, due diligence, assess them, and then choose the right company to invest in. So these are very a bit more sophisticated and very developed kind of investor. There are also some other way that you can also raise one. For example, some crowdfunding or co-investing kind of platform,
right.
like Angel Hub in Hong Kong. There are also other so they are pulling together a lot of pre-qualified angel investor individuals, like anyone who would like to invest but do not have the time to look at to work with individual startup founders one-on-one, like as an angel investor. They will sign up to one of these platforms, so they will keep on receiving interesting company to invest in. They will look at different opportunity, and then the platform will do a lot of due diligence. And then once that process is done, they will decide, okay, I would like to put in some tickets some there. So they will put together, most of the case, it will be ideal if they are put together as a special purpose vehicle. That means that you're not dealing with 100 individual investor. You would deal with one, a very organized kind of entity. And then there are also two more, which is not that common at the very, very early stage, but at some point when you are reaching a state of growing, you will start encountering them. So one is established company. They might have corporate venture arm, so CVC. They will be looking from their perspective. Let's say I'm making certain bakery biscuiting, and I would like to look out for what are the interesting new innovation and product out there that is started by a startup, not internally derived. So they will look out for that, and then they set up a separate pot of money to invest in this company to learn, basically to learn more about the latest trend. Maybe that will turn into some very interesting partnership later on, but they will start with a smaller amount of investment to begin with. And then last but not least, there are also some individuals or even iBanking sort of company who will try to say, hey, if you don't have a lot of resources to do the fundraising, because it's really taking a lot of time and your effort and energy of doing that. So they have their own network. They would actually let other people know that you're fundraising, and that they will bring this investor to you. Of course, in return, they will also take part of the proceed from the fundraising. It could be a certain percentage. And then if you take it into account that you don't have the time, the cost to hire a dedicated person, that might make sense. So these are all different parties related to fundraising kind of ecosystem. And you might want to understand the focus, the motivation in interacting with you. That will be very useful in your discussion and interaction with them.
Right. So thank you, Carrie, for the very extensive group of various avenues to find funding to run the company. Now, as a business owner at the very beginning, would you recommend some groups better to be better suited than others? So, for instance, we might not consider, say, investment banker at a very early stage.
Right.
We prefer to have an angel investor to come in to advise and guide the business owner along the way.
Yeah, I would say that both angel investors, accelerators are actually very good starting point. And to a certain stage, there are some very early stage VC. They would also be very helpful as well. By being on accelerator or VC, you will actually also gain a certain kind of credibility for yourself, because they do represent their expertise in that particular area, be it IoT, be it AI or blockchain. That means that they have looked at a number of companies and then they decided to invest in you. That sends signals to subsequent investor in the later round, etc. That, okay, this company, they've gone through a bit rigorous assessment by a more professional and dedicated kind of investor. So that will definitely helpful one way or the other. So I think the top will be angel, accelerator, and VC. Early stage VC. Yeah.
Yep. Let me take a pause here, right? So guys, if you have been enjoying this video stream, please make sure to sign up for the free membership of FEW in the web app. And as a member, you will receive exclusive offers, collaboration opportunities, and complimentary business advice. So welcome back, Carrie. Let's continue from here. Oh, one more thing, guys. If you have questions, please ask questions. It's so hard to get Carrie's time, and she's spending time with us here at FEW. We're so grateful to have her. So please ask questions. If you're using the mobile app, you can post a question using the question box. And if you're using desktop, please raise hand, and we can direct the screen to you to post the question. So now, coming back, we were talking about fundraising with Carrie, and now let's move on to the second part, which is pitching to the investors. So Carrie, when you're doing various pitches to all kinds of different investors, what are some of the most challenging parts you had to deal with in the pitching process?
In our case, I think pitching actually started well before the pitch happens. So in order to be being smooth and having a higher chance of getting the investors' interest to follow up with your investment opportunity, there are a lot of things happening even before the pitch. So I would say that depending on what stage the company is, definitely a lot of work related to your business plan, your strategy, your company differentiation, if there are other competitors in the similar space, the prototype you have also done, as well as the team and how the team is doing. at the next milestone. And one actually thing that we could easily, I think that we could do better. We done okay, but we could do better is actually on the visibility. That means that even before you go out to fundraising in your area, you might want to have your company or what you're doing in different social media platform, professional platforms about what you're doing. And one way or the other, the most efficient way is to let them know your company exists, your service exists, and one way or the other, you will attract some investor. We do have our flow of investor actually coming to two directions. One, we really target those who are already actively investing in this space, and then we approach them. Actually, some of them, they would actually write to us by getting in touch either through LinkedIn or through our company website. And so both targets group actually have their own pros and cons. And I would say that those who already know you before you start to pitch will be definitely much more interesting and efficient for everyone. So I think the pitch actually started with that. In our case, I think the business model, we solve a problem which is quite obvious, which we produce meat, and so the environmental benefit actually quite obvious out there. However, the business plan of how we go to market, how they differentiate in terms of technology, the market sizing of our pilot product or the product pipeline is actually the few areas we pay quite a bit of attention to. And I would share that at the beginning, we try to approach this angle by coming up with some very exclusive and very exotic ingredient product in this market, which namely fish maw. We make cultivated fish maw in our first prototype. And however, very quickly, we realized that investors asking us about, so what is your total target market size, addressable market size? And although on the product level, the price parity and everything looks good, but then the market size might not be, great enough to attract their investment.
Fish maw is a very Asian, it's very Asian kind of product. Exactly.
Yes, and then the culture is a little bit different. So when it comes to food, that the cultural preferences and how we operate started to see quite a difference between how we operate. So for Asian investor, they are all very excited about it, especially those of us, we eat this and really like this. But then for Western investors, we do need to explain to them at extra length to tell them what it is. Some of them understand the model. They actually that's why we also got international investor from US and Europe. But for some other, they just cannot wrap their head around it. So it's a little bit difficult for them to understand that product offering. So that's why we keep on improving and pivoting a little bit in order to cater for both for that financial perspective as well as for company strategy perspective. We do need to broaden our product base and market, addressable market size, etc. So these are the few challenges, and usually would be engaged in a lengthy conversation with an investor on a pitch call.
Right. So okay, we do have quite a few questions streaming in. So let me just ask my final burning question to you, Carrie, and then we will move on to Q&A. And that is, first of all, how do you get introduced to investors? And then how did you convince and get your first investor on board?
Okay. So again, the fundraising, the pitching does not start on the day you start thinking about the money. It's actually started, it could be more than 6 months to 9 months. In my case, it started from the time when I attended the first industry conference that was in Berkeley in San Francisco, where I went there a little bit prepared meaning that I have my company incorporated and have my business card printed so that I can exchange my contact and can follow up with discussions. So I went on to the conference without a co-founder. And then in that platform, that's how everyone is very interested in the alternative protein, plant-based, cell-based, and everything. And I had the opportunity to chat with a lot of participants in that conference, and some of them are actually investors. So I exchanged business card with them, and afterwards I follow up with say, hey, I'm actually starting out a venture. in this part of the world, which is we are the first one in China. We're actually the third one in Asia. So it's not a lot of company doing that at that point of time. So some of them looking to diversify geographically. They're actually very interested. So that's how I actually got contact with a number of potential investors in the pipeline already before I actually start fundraising. And one of them actually turned out to be our pre-seed stage investor. So that's something that you would like to do along the line. Yeah, so that will be my suggestion. Before you fundraising. And the other thing I would like to raise is that do not go out to fundraise when you need the money. It is because that the less you look like you need money, the more money you can raise. So yeah, do not go there. You expect a runway of at least 8 months, 9 months, if not 1 year, and then you are not in a position that you're desperate for the investor money. Then it is actually better, because in the sense that people realize that it is risk and also the investment. And of course, if the risk sounds very high, by being the company running into quite a bit of trouble in a short period of time, it might not be selling too well. So I think that to start fundraising, maybe 8 or 9 months, if not even earlier, before you actually need the money, and that will make things even more smoother.
Nice, thank you, Carrie. So let's move on now to our Q&A. I'm going to reorganize the questions a little bit. The question by Donna is actually quite related to what you were talking about in terms of finding the investors. So Donna's question is, when you first approached the investors, what was the percentage of people that say yes and no to you?
Okay. Yeah, so someone said that it's like a numbers game, just like, I don't know, just like dating. You date enough people and then you find the right person. And I think, can't remember, I think for the first round, because this market segment is a little bit more focused and a lot of mission-driven investor, so they are kind of very visible to us already. So we approach them, some of them we already know through our network, etc. So I think it would be maybe 1 to 2 out of 10, that kind of percentage eventually investing, sort of for the first round. And then second round will be a little bit better. So yeah, that's what I would say. Very rough. Yeah.
Yeah. But Carrie, I really think, just based on what I've heard in the market, it is really very fortunate, and it's I guess because your product is so strong, and the market size and the product market fit, everything is there, that you had such a nice 1 out of 2 yeses. So based on what I heard in the industry, so because I guess because you're doing something very specialized, so you're very targeted in approaching your investors. For other business ventures out there, I have heard stories about getting 18, so 20 rejections, very common, before they finally end up with that one yes from the investors. So it's really a spectrum. For Carrie's case, she mentioned it's 1 in 2, and then it got better in the second round.
Yeah, clarify. I think it is not 1 in 2. That's really too high. I think it's like roughly about 1 to 1 in 8 or 10. I think it's also a matter of how much potentially irrelevant party that we address, right? So yeah, I think that is, we are actually quite average in that regard, in terms of that number hit rate, sort of.
Okay, that means to say, in fact, it's maybe 1 in 2 that says yes to meeting and learning more about what you are doing, and then 1 in 8 or 10 that actually ended up taking investment, so investing in your company. Is that correct?
Yeah, I mean that maybe 1 in 8 or 10 is eventually investing, but then for meeting it will be about, I think the last year 2020, early 2020, it was not that good. It was like 1 in 5 or 6. Now it's actually 1 in 3 to 4. So because we see more investor originally, they're not focusing on this, they also would like to learn, sort of. So that turned out to be a bit more calls.
Yeah. So I think I think the gist of the day for everyone is just keep trying. And a lot of Andrew Horowitz, he wrote a book, right, The Hard Thing About Hard Things, and he said that yes as a number. So I guess we just have to keep trying, and after tens and maybe even hundreds of rejections, we have to have the conviction that there will be one yes at the end of the day. Okay, so moving on to the next question from Eliza J. Okay, her question is very specific. She's asking about the financials that we prepare to fundraise. She's asking specifically what kind of financials, financial figures, the math, the calculation that needs to be prepared, as well as what are the the very detailed information that we have to put inside the pitch deck. And she asked whether you could be a little bit as specific as you can in terms of items.
Yeah. So it's totally related to the stage of the company. When we were in pre-seed stage, honestly, I maybe if you look into those very sophisticated DCF model, it's basically just garbage in, garbage out, because basically no one knows what was happening. So for the really pre-seed stage, you would like to do a lot more work on the market sizing, what exactly you're doing, and what market you can address and you can assess. I think those are and then how it looks like justified by your product offering. How does it look into the market size that you said you are trying to conquer? I think we did a very rough number in terms of the a bit more top down, like the market is that big and in Asia is that, and if we are, you break down to seven layers, and if we break into a different region or different kind of application, the size will be that, and we're actually coming up with a service or product that we're addressing to that market. If everything makes sense, that would be already, consider that part like a check. As you know, the VC at the very early stage, they run not on the very specific numbers. They more operate like a scorecard or like a picture about the team, the proposal, the idea, business model, and how they can address that. Not really that much on the financial number. Of course, if business is already in operation, let's say you're already producing something, you already have your customers, then you would like to do very specific, your record of your revenue so far and how you project to increase the number of customers, their average purchase size, volume, and your cost to procure and acquire new customers and things like that. So that would be more like a operating business kind of model. In our case, we are biotech, so we are still maybe 12 months to 20-ish months to market. So we cannot project revenue until I think most recently, whereby we know a little bit more about our cost of production, our business model a bit more well discussed and argued. So we start projecting our model more like still not very DCF, but still running more like a financial statement, profit and loss, our revenue, what are the product stream, and then what is our cost of service or cost of goods. We need to actually, project our SG&A, how many headcount we are going to hire for the next 3 to 5 years. The next year definitely very specific, but then the year afterwards, you do want to project quite a bit as you scale up. So the capacity, the team size should match with the revenue projection. You cannot have 10 people selling to 10 account and 10 people selling to 1,000 account. You want to project that, and then you want to have all those assumptions. Bear in mind that it's just assumption, but it needs to sound like real. You want to have it verified by either your advisor or people in that business to have a quick look whether it makes sense. For example, SG&A for biotech or certain tech company, if you are less than about a certain percent, it's not going to make sense. Mm-hmm. If you say that I have a very big margin, EBITDA margin, but then your SG&A is not matching with what you claim you want to do, R&D and doing more on the technology and research, it does not make sense. So I think those are the level. We just had a discussion with our investor the other day. Investor look not at the exact number that much, but they are actually trying to understand your thinking, your idea, and how your plan going forward from that model rather than the actual number itself. Because we know that everything will change. The cost will all of a sudden jump up. The price would, you will become competitive. You need to adjust your price and so on. So the number really does not matter too much. Your assumption behind that is actually the most important.
Thank you for the tip, Carrie. I'm also mindful of time. I'm just wondering, Carrie, do you have time for one more question?
Yeah.
Okay. So based on your experience, besides the many rejections, what was the hardest part of fundraising?
I think the hardest part of fundraising in our case is that people, in particular, if you're working on something like either new business model or new tech, people don't understand the tech. So for example, at the beginning, we have a lot of people ask, so is it cloning of an animal? Is it you're operating like GM? Is it safe to eat? That sort of question. So that's the toughest part. And then we have people very interested in this space, and then they new to this space. They very much look like, when are we making money and when are the margin? And then we try to explain to them that is the technical part, that's the R&D, what we need to take to get the commercialization, what are the risks that come with that. And then without spending enough time to understand that, rushing to trying to ask you about the revenue, the profit, etc. And it's very difficult. So in some cases, we do realize that there are different audience. Some of the audience, they might still be getting self-educated. They may not be really ready to go on more in-depth discussion in a more direct way. Some of them may be wasting time. So we do quite a bit of educational section here and there. We don't mind. We actually building more friends and trying to build more, awareness and understanding of this space. But I would say that maybe half of the time, even we're actually spending time to let people know what this tech is about. And then one or two of them may turn around after a year or so to invest in us. But some of them, they will go and think about other investment opportunities if they don't understand that. So yeah, no hard feeling. That's the challenge.
Great. Thank you for the advice, Carrie. We have come to the end of our live stream today. Once again, a big thank you to Carrie, who's here with us today. And of course, a big thank you to all our audience here. You guys are wonderful. Now, if you are interested to check out our future calendar of events or submit a request for live stream, please visit our website at few.community/askfewanything. If you enjoyed this episode and want to learn more, please sign up for our free membership on using the web app. As a member, as always, you get connected to other like-minded people, industry leaders, and get exclusive offers and complimentary business advice. So once again, thank you, everyone. All the best to you, Carrie. We really enjoyed our session here today with you, and wishing yourself and Avant all the best and good luck.
Thank you, Megan. Thank you, everyone. Thank you for having us today. Wish everyone a very successful year.
Thank you. Bye-bye.
Bye-bye.